Welcome back. Currency markets have been at the epicenter of Brexit mayhem. And let's get some currency strategy with Khoon Goh, head of Asia research at ANZ. What a week. And we'll take it really one day at a time, right? So let's start with sterling. We've seen manic volatility. I talked about 1,700 pips and even beyond that within a matter of hours on Friday. We seem to have found some sort of stability, but it looks like a lot of hedge funds are placing bets at around, initially I heard 120. The next stop I hear is 110. What is your view?
I think sterling will certainly come under further downside pressure over the coming weeks and months because the uncertainty that they find themselves in is really unprecedented. And we don't really know how things are going to play out. So while technically nothing has changed, the UK is still part of the EU for now, but we don't really know how the divorce is going to go. We don't even know when they're going to file the papers, and we don't even know who the new Prime Minister is, and we don't even know who the new opposition Labour leader is going to be.
So what's your near-term target?
So I think we're going to see sterling heading down towards a new trading range. I think the 130 level, which is a key level, will probably break in the coming weeks as the uncertainty starts to weigh. So I won't be surprised if we start to see it heading towards around that 125 level over the coming weeks and months.
For now, a lot of talk is reverberating about easing. But if we take a look back to the experience in 1992, when George Soros became the superstar of having broken the back of the BOE, one could argue that maybe at some level it could trigger the Bank of England to hike rates. Back in 92, they did it to as high as 12%, 15%, although it was a very brief period.
I don't think the Bank of England will look to defend the decline in the sterling by hiking interest rates because, quite frankly, I think they'll do more damage to the UK economy than necessarily assist it. I think the sterling is doing exactly what it's supposed to do, which is a shock absorber. The UK has experienced a huge shock and the currency market has adjusted accordingly. And they put it quite frankly, the UK is running quite a large current account deficit at about 5.2% of GDP. Now, when it was part of the EU, markets didn't really put too much focus on that. But now that it is looking to be outside of the EU, suddenly funding that deficit becomes a little bit more problematic, particularly with the UK losing its AAA rating status.
Are there some better pairs to trade? What about the Sing dollar?
Sing dollar should continue to outperform sterling. So sterling Sing currently we're about 180. I see potentially a move towards 175, and also against other currencies such as the Aussie dollar, for example. I mean, Australia still has AAA rating, higher yields than sterling, and I can see a lot of FX reserve managers wanting to switch their allocation out of sterling into other good quality assets.
Yeah, AAA club getting smaller and smaller in this environment. RBA meets next week. Is it expected to do something, or is it going to wait at least until August?
I think they'll probably wait and see how things play out. August is probably the most likely timing if they were to decide to move. The Australian currency is sort of stuck in the middle at this point in time. It still has some very attractive properties, but yet at the same time, in a risk-off global environment and downside growth risk, typically the Aussie doesn't perform too well there.
What about the dollar yen? There's so much talk, anticipation about this bold move from the Bank of Japan. How would you trade dollar yen at this point in time?
I would actually, to be honest with you, steer clear away from that because while you can argue, given a risk-off environment, safe haven flow should push dollar yen below 100, the threat of intervention is there and growing the lower dollar yen gets. And also, I think the Bank of Japan, there's a strong likelihood they will come out and ease policy further at their July meeting in order to try and offset the downside risk, bring inflation up, and more importantly, trying to get the yen weaker.
The Chinese renminbi, the trading band has been weakening. Do you have is there a good way for traders to take advantage of some of the opportunities?
It's quite interesting that the Chinese authorities are a lot more comfortable in allowing the renminbi to weaken. In fact, on a trade-weighted index basis, the renminbi has been weakening since late last year. They're down about almost 6% so far this year. And that's actually going to create more headwinds for other Asian currencies. A better way to play it is actually to short other currencies that are competing against China in third markets, such as the Korean won or the Taiwan dollar.
Okay, great stuff there. Khoon Goh of ANZ.